Hello there, folks. Today we're diving into the thrilling world of derivatives. Don't touch that remote. It's not as dull as it sounds.
Think of it like this. Your neighbor Bob is obsessed with his lawn. You know, the kind that's greener than a leprechaun's hat. Now, imagine betting on whether Bob's lawn will win Best Lawn of the Year or if it'll be destroyed by a sudden meteor shower. That's a derivative in a nutshell.
Exactly. You're not directly betting on the lawn itself, but on an outcome related to it. Will it thrive, or will it be a smoldering crater? Derivatives are similar. They're financial contracts based on the performance of an underlying asset like Bob's precious lawn, or, something a bit more practical like stocks, bonds, or even the price of pork belly futures. Don't worry, we'll explain those later. The point is, derivatives let you make bets on things without actually owning them. It's like wearing your team's jersey to a game and screaming your lungs out, but instead of cheering for victory, you're cheering for your financial prediction to come true. Now you might be thinking, Dan, this sounds like gambling with extra steps. And you wouldn't be entirely wrong. Derivatives can be risky, just like betting your life savings on a coin toss.
But here's the thing, derivatives serve important purposes too. Think of derivatives as a financial safety net. They help businesses manage risks, like fluctuating interest rates or wild swings in currency values. Imagine a company that imports coffee beans. They use derivatives to lock in a specific price for those beans in the future, protecting themselves from sudden price hikes. It's like prepaying for your coffee fix, ensuring you get your caffeine without breaking the bank, even if a rogue goat eats all the coffee beans in Colombia.
Derivatives also allow investors to speculate on market movements. They can make calculated bets on whether an asset's price will go up or down. It's a bit like predicting which way the stock market will go, but with fancier financial instruments and potentially more zeros on your paycheck. Or, less. Now, let's get into the nitty-gritty of how these things actually work. Imagine a giant, complicated machine with gears, levers, and flashing lights. It's confusing, intimidating, and probably smells faintly of burnt popcorn. That's what comes to mind when people talk about derivatives. But fear not.
At their core, derivatives are just contracts. Two parties agree on a specific outcome and the price they'll pay if that outcome happens. It's like making a bet with your friend on who can eat the most hot dogs. You're not trading actual hot dogs, but you are agreeing on who owes what based on the outcome.
There are different types of derivatives, each with its own set of rules and quirks. There are futures, options, swaps, and probably a few more that even Wall Street doesn't understand. But the basic idea is the same. You're betting on something without owning the thing itself. It's like having a say in the outcome of a pie-eating contest, even if you're lactose intolerant. Now, here comes the slightly less thrilling, but equally important part, accounting for derivatives. You see, when you're dealing with these financial instruments, you need a way to keep track of all those bets, risks, and potential rewards. That's where accounting standards come in.
Think of it as the rulebook for derivatives. It tells you how to record these contracts in your books, how to value them, and when to recognize any profits or losses. It's not exactly as exciting as watching paint dry, but it's crucial for ensuring transparency and accuracy in financial reporting.
The goal is to give investors a clear picture of a company's financial health, even if it looks like they're juggling chainsaws while riding a unicycle on a tightrope. Because, let's face it, derivatives can get complicated. But hey, at least the accounting rules are there to prevent complete and utter chaos.